You set up your S-Corp, you got the entity, you got the EIN, and then you started taking distributions because that's the whole point, right? Here's the problem. The IRS expects payroll setup for that S-Corp, and skipping it is one of the fastest ways to land on their radar. Payroll mistakes don't come with a warning. They come with a notice. And by that time the notice shows up, you've been wrong for a while. So today we're getting into exactly where it goes sideways and what to do about it. Welcome back to Unfiltered Profit. I'm Caitlynn here with Seanna, and before we get into today's topic, I want to speak directly to a specific group of you for a second, and you'll know if it's you. You've crossed the $1 million mark in revenue, maybe recently, maybe it was a couple years ago. And right around that time, someone, your accountant, your attorney, a fellow business owner, TikTok, told you that it was time to set up an S-Corp. So you did. You got the entity, the EIN, you made it official, and then you kind of just moved on business as usual because you had to keep running the business. But what nobody fully walked you through was that S-Corp required a payroll obligation. And that gap is what we're talking about today. Sean and I are getting into the payroll mistakes that show up most often at this stage. S-Corp owner compensation. What happens when you hire across state lines? What do PEOs look like? What do you do when you swap providers? And what that notice you got actually means. We also have something fun to tease. Later this year, we're bringing on Christina from Valor Payroll Solutions for a full expert deep dive. So if today raises any questions and you want her take, send them in. We'll give you the details at the end of the show. So let's get into it.
Yes. So if you listened a few episodes ago, we kind of teased Christina coming on, and then mom life occurred for all of us.
All of us.
And after multiple reschedules, we were like, well, we're just going to try later this year. And Caitlynn and I agreed that this was just too important and timely of a topic to delay the whole conversation. So we're going to get into parts of it from our side. But Christina truly is an expert, especially when we start talking about state requirements. And that will be a great conversation to dive deeper into later this year.
Agreed. Yeah. Summer is just not the best time to get three working moms together on a quiet podcast episode.
Yes.
Got all the kids running around.
Yes.
So, yes.
Well, let's dive in. We have like several different topics, and a lot of these are ones that we have seen very recently, and they're all things that we see multiple times. And I think there is this like misconception that just because you hire a CPA to do your tax filings, they're thinking about all of the aspects of compliance for your business. And this one in particular drives me nuts. So we're going to talk about S-Corp owner payroll. And so as Caitlynn talked about in the intro, we'll often have clients come to us that have made their S-Corp election, whether they're an LLC, made the S election, or they've set up a corporation and made the S election, and they're not running payroll. And they haven't been for years. Well, like honestly, we have like several clients right now that this is all something that we're having to play catch up on. This is not an infrequent issue. And there's trouble brewing.
And there is. I mean, we saw it, I want to say, I really started seeing it at the rise of like 2020 timeframe where for whatever reasons, we weren't going in the office to like meet with our CPAs, or there was an influx of like influencer type CPAs. And so suddenly all these S-Corp elections were getting made, but nobody knew the rules. The clients didn't know the rules. But we can go all the way back to then. I would get clients and they'd be like, somebody put me in an S-Corp and I don't know what to do now. And those were the lucky ones where we were able to run a payroll last minute before the year end closed. But it's not uncommon to get them 2 or 3 years down the line. And there hadn't been any payroll ran for the owner. Now, if the owner never takes a cent out of the business, fine. Like, you're not required to run that payroll to put your business into a loss. If you're not taking any money out of it at all, then you're fine. You don't have to run that payroll. But the minute you go and take a distribution, and we're not calling it payroll, now the IRS is going to start questioning what's going on. Why are you trying to essentially dodge FICA taxes, which is what it is on paper, what it is to the IRS, and that you are getting too much of a tax benefit for this.
Yeah. So we talk about the basics real quick. And I know we've gone over this before, but we're just going to say you're an LLC. And so you've been running like an LLC, everything flows through to your personal return. You're essentially paying those FICA taxes, that Social Security and Medicare on every single dollar of net income in the business. So you can take all the distributions you want, doesn't matter. All of it is subject to FICA taxes. So then the influencers out there, and this is legitimate, like this is the benefit to it. They say, go make an S election because now it's only your payroll piece that's subject to the Social Security and Medicare. And as a business owner, you know this, if you're a W-2 employee for someone else, your Social Security and Medicare is 7.65%. And then when you're a business owner, I always forget the math, that is 15.3%. Yeah. So it's a lot, right? There's 15% tax savings on the portion that is not under payroll taxes when you make this election. Great tax savings, but you still have to pay yourself a reasonable salary in order for you to not get in trouble with the IRS. So when you make that S election, and now you're taking distributions, now you're sheltering all of that money from FICA taxes, and IRS don't like that.
They don't. And you don't like that, right? Like you pull up your Social Security statement, guess what? It's showing no wages those years, and that is not good, right?
Yeah.
And we've seen all the workarounds. I've seen where like a CPA will say, we'll pay the owner as a 1099 and flush it through the Schedule C. That's not the right way to do it. The right way is to get payroll set up to file your 941s, your 940, your state withholding, if applicable, your state unemployment. Great softwares out there to do it for you.
Yep.
I mean, if you really want, you can go paper filings. Those still exist for these forms, but it needs done. You need to have a reasonable discussion or analysis, which is usually a paid for service, or again, that discussion can happen. If you don't want to have that discussion, you can just call it all payroll, and then your S-Corp probably wasn't worthwhile. But that's the option is there.
Yeah. And even I saw this in setting up a Gusto account recently. They have a reasonable compensation calculator in there. Am I saying that that's the best way to go about doing it? No, but it's something. It's a starting point so that you don't choose something that is way too low, because you can't set $1 or just randomly $20,000 or anything that you randomly believe in. I know that we've done a deeper dive on this conversation and how you kind of break down that. So we won't dive too much into it here. But the other thing I'll see some CPAs do sometimes is they'll be like, oh, well, we just do the forms in Q4. So like in December, they're going through and they're reclassifying some distributions to payroll. And then there's taxes that have to be paid and all that piece. However, what I'm seeing more frequently right now is our clients coming back and saying, oh, I reached out to the CPA, because I'll ask them like, hey, did they file any 941s for you? Knowing that this is a tactic some people do of just doing the paper filings. And they'll send me the response and it's like, no, you had no payroll. It's like, understand there was no payroll. There should have been the payroll. It should have occurred.
It exists. It exists. Yeah, it is. I'd say it's for smaller businesses, right? Solo businesses where it's just you, where you're not trying to match your cash flow. Totally makes sense that maybe you're doing a December payroll. You're pushing all of your estimated taxes through on it because for tax purposes, that's considered timely paid all year. There's strategy behind that.
Yep.
But it still needs done and you still need the cash. And if you're bad at cash, you just run it throughout the year.
Yes. So if you are an S-Corp and you're not on payroll, even if you run it for your team and you're like, oh, I'm not on there personally as the owner, you need to be. So fix that. And then you need to also look, we're recording this in May and it'll go live, I think, in May of 2026. And so, at whatever point we're 4 months into the year and you've taken some distributions. So you've got to kind of factor that in with making sure you've got a good balance there from the reasonable comp standpoint for the rest of the year and the cash you're taking out. So it might look like setting a higher reasonable comp rate for the rest of the year so that enough is pulled throughout the remaining months. And then you back that back down in 2027. So just keep that in mind.
Yeah. And their strategy, right? So we have talked in depth about S-Corps, but their strategy to that reasonable comp. Let's say you are paying for health insurance premiums through your business as an S-Corp owner. That goes into that reasonable comp box 1. So maybe your actual wages do get to be a little bit lower because there's so many ways to play with this. But as an S-Corp owner, you have to be careful that most of the time, what we would call like fringe tax benefits, fringe benefits, health insurance, HSAs, FSAs, all of those are actually taxable to you in box 1 and get sorted out later. So if your business offers benefits as an owner, you've taken advantage, you also need that discussion of like, hey, am I treating those benefits the right way? And this is probably the number 2 mistake. 1 is like, we don't run payroll at all. 2 is folks will pay for the health insurance and not capture it in box 1 and still take the deduction on the 1040. And that's also a big no-no on how we treat S-Corps.
Yep. All right. Let's move into the next one that we see most commonly wrong. So we've talked about owners. Now we're going to talk about employees. And in this wonderful virtual world, which Caitlynn and I run a virtual firm, so we are very well acquainted with all these issues, is multi-state payroll. Just because you exist in one state does not mean that you get to treat your employees like they work in that state when they don't live there and they don't work there. So you can't do that. You've got to go register in that state, and you have got to set up all your unemployment and your withholdings and all the things and remit those. But wait, there's more.
Always more.
Yeah, there is more from the standpoint of having an employee in that state also can create something called nexus, which means now you've potentially got to file a tax return in that state and apportion your revenue to that state. So there is a lot to think about when all of a sudden you have employees in a state different from where you are. And if you've ever spent any time on job boards for remote postings, you'll notice that there are some job postings that are like, but we will not take anyone in California, Washington, New York. And I think that state list is getting longer and longer every year because some of them have some very ridiculous setups. Like Washington State, if you have to actually register as a foreign entity in that state if you have employees there. Great, more state filings. That's not fun.
Right, because you have to register as the foreign entity. You have to get a registered agent somewhere because the idea is that you can be served with paperwork. So if it's not you, it's got to be a paid service.
Yeah.
All of the appropriate employment pieces. And then if it's an income state, like California is a really good one. So you have paid family leave pieces, but you also then have them saying, hey, cool, you have workers here. I need you to take a piece of that income that you made. So you could live in Texas. When you have an employee in California, guess what? You're paying state income taxes now. And a portion of those to California because you hired there.
And to be super clear on what that means you are now filing a business tax return in California, and you are filing a personal tax return in California.
Because you're a flow through.
Yep.
Yep.
So even though you don't touch California at all personally, your business does. Mm-hmm. And that is a pain. And it's also something that is not handled incredibly well by all tax preparers.
Multi-state is a beast in and of itself. I mean, my history is with entities with 30, 40 states that we would have to file in. I will always prefer a corporation at that point because the corporation is its own entity. And so it makes it really clean, right? I can just say the corporations in all of these states, the corporation will pay those taxes. No K-1s come from it. We can just wipe our hands clean. But there's a lot of other issues there. The other state to be aware of payroll-wise is New York, who, if you go and conduct business, which means you flew in to have a meeting for a day, you have now created potential New York filings. And I don't know if this is the case. I've been out of the corporate tax sphere, like the big corps, but because so many corporations have headquarters in New York or they're going for Wall Street purposes, New York would actually watch the news and they would look at the newspapers to see who was having big corporate meetings in New York. They'd go find those owners or those people of those companies, and they'd go and see if a New York return was filed for those 3 days, 4 days, whatever the case may be. So you're talking about major tracking on both sides. And of course, as a preparer, you're like, where's your budget? Because can I have some of that if you can spend this time? But again, they don't play. They know that so many people are flying in to do business in their state and they want a piece of the pie. And so this is how they've been able to sculpt the rules to get a piece of the pie. I don't know if that's still the case, like I said, but I think 5-6 years ago, that was not uncommon.
Wild. Just wild.
State taxes.
Yes.
I tell you. And they're all different. And we can go back to all the court cases that landed us here, but it's not just sales taxes anymore, right? The big news was sales taxes a ways away. And then when everyone went remote working, the state started saying, hey, I can get a piece of the pie this way. So it used to just be, you had to have property there, you had to have payroll there, and you had to have sales there. And you just did a nice calc. And if the calc turned out super small, then you're like, whatever. But quickly, that payroll could even mean, right? Your employee lives in New York, but has chosen for whatever reason to go work in New Jersey. You could potentially own New Jersey. These are just things to watch about. If you're an employee listening to this is why your employer got strict about where you were allowed to work from.
Yeah. And rightfully so, because it is a whole thing, 100%. And so to kind of lead into the next one, if you're like, how do I fix some of that pain, whether just general payroll or the multi-state? This is where sometimes a PEO can make sense. So to put that in English, a PEO is a professional employer organization. And so they have a co-employment with you as the owner of a company. We recently moved to a PEO because of, again, our multi-state setup. And honestly, wanting to offer some better benefits, because when you use a PEO, there is more of a pooled employee benefit because they are essentially this co-employer over thousands and thousands of employees. So there's a lot more from an economy of scale they can do benefits wise than you can do as a small employer.
Yep.
And so there are a lot of benefits there. There's obviously additional costs. So there's this like weighing of, when does it make sense from a tax standpoint? Like, oh, well, that's less returns I have to file. That's less complexity. That's less tracking. All these things that can go into it offset that cost on a monthly basis and the benefits that are there.
Yeah. And it is that cost benefit analysis, and it's the values, right? We could have handled our multi-state issues. It was, we couldn't get benefits. We could not get them anywhere close to affordable because of our size, because of how we're spread out, structured, all of the things. And so it was worth it. It was worth it to align with the values that we wanted our employees to have benefits. And this was the way to do it, because Sean and I are military spouses. Like, we are very fortunate that our benefits are covered, but that created complexities that we just had to find a way around. And this was the way.
Yeah.
So we love it for that. We love it for if you're just like, I want to keep my life easy. PEOs don't give you those nexus in that states that we were talking about, because the PEO owns them. That's their problem, not yours. So you get to go back to being like, hey, I live in Texas. That is where I will file all of my stuff. And this is simply wages onto my return. That said, untying yourself from a PEO can get complicated. They have set up the workers' comp rate and the employment rate, unemployment rates, and the benefits. And so your 401ks, all of that piece becomes a little bit heavier of a lift if you want to someday leave it, if you've decided to bring everything in-house, whatever the case may be. You also kind of lose some of that HR control, because they are now kind of still between you and that employee. The contracts are written in such a way. So making sure you have a good lawyer to read it all over, and that if you ever want to exit, you kind of have a plan of how that looks. That said, a lot of folks will stay with PEOs for a long time. It removes having to track some of those like thresholds that you hit for like, oh, if you have this many employees, this is now the benefits you have to offer. If you have this many, like, it just removes a lot of that tracking for you, and someone else is now handling it.
Yeah. So from a compliance risk standpoint, there is a nice reduction. Again, there is cost to it, no lie there for sure. But then we move into PEO versus payroll. Should you do it internally? Should you outsource it? There's a lot to consider here. I think if you get to that point where you are like, oh, well, I've not been doing it right, especially if listening to some of this multi-state stuff, you're like, oh, I didn't realize I couldn't set them up that way. Or, well, QBO makes me input them this way. I have a lot of problems with QBO payroll, especially when you have people that cross board, like any sort of multi-state situation, QBO just does not handle it well. So if you're like, I'm just running QBO payroll, that's probably a sign that you need to change.
It's time for a change. It's like step one. QBO payroll means it's time we're getting someone new.
Yeah.
We like Gusto. We are trying JustWorks from their payroll side. Rippling has a payroll. Like there's a lot. ADP. I know. We don't love Rippling either, but they exist. They're also a PEO.
Yeah. Yeah. ADP.
But
Paychecks. There are lots of them out there. It's worth getting some opinions from people about it. And to be fair, like with payroll as HR, like people don't have good experiences with that whole realm of business life. So you'll talk to people that are like, I hate Gusto. I'll never go to them. People will say that about every single company that is there. So definitely make sure you weigh the source of the opinion when it comes to that. We can certainly share the ones where we felt like there has been great customer support versus non-existent customer support. That's one of the reasons I do like Gusto, is that they have done pretty well. Despite not liking Rippling's platform and feeling like it's built for bigger companies, I do think that their customer service is pretty good. So I will throw them a bone for that.
yeah. And so I'd say the software, right? So if you're in the software and you're trying to DIY it with a software, Gusto, QBO payroll, whatever the case may be, usually what we start hearing is like owners are like, Gusto's like, there are all these alerts when I log into my homepage and I don't know what they mean and I don't know what to do. That's when they start looking for like something like us to come in and help. But there's even a point where if that's the path you want to take, right? You want to do it internally of sorts, you want control. But now we're talking multi-states, HR issues. That's when even we will sit there and say, hey, someone like Christina, where all she does day in and day out is payroll, running it, compliance with it, that even starts to make sense. And it depends on your level. It can even make sense at a smaller level to have a true payroll expert who that is their only job all of the time. And so if you're like, no, I don't want a PEO, I want more control, but Gusto isn't really doing enough of the hand-holding that I want, that's when you start looking, I would say, for like a firm that specializes just in payroll, because in and of itself, that's a full-time job.
Yeah. And even with that, some things to think about and ask about as you're considering those providers are, okay, how do you handle my 401k contributions that have to go over there? Because, you know, the Gustos, the ADPs that are, I'll say, plug and play, they have their 401k providers where it's very easy for things to just like one big draw from your account and everything is handled. Others, it's not so much that way. And so there has to be this like conversation on a weekly basis, especially depending on where your 401k is, where it's like, here's what is owed, here's what to pull, back and forth and back and forth. So all of those aspects are things to consider when you're like trying to build your accounting ecosystem and who is supporting you in that process.
Yep. And 401ks, I think, are the only benefit that you can change throughout the year. You can turn on, you can turn off, you can up what you're inputting, like up what your savings, lower what your savings. And so if your systems aren't talking, you really do run a risk of being under contributed, over contributed, whatever the case may be. And so the rest of them, right, you set it open enrollment and that is what it is. But 401ks, the employee can go in at any point and adjust. And so if your systems don't talk because for whatever reason you chose that method, then you need to find a solution for it, and something to consider when you're looking to hire this piece out or when you're talking to solutions that like, hey, my 401k is held over here, but I want to use your software. What do we do so that we're not, because there, I mean, you talk about more regulations. IRSA has its whole beast and they don't play with you making sure that 401k money makes it to those accounts. You are not allowed to hold it.
Yeah. Yeah. And I think that's a big one. This is payroll related, but tangentially, it's very common for clients to go in and talk to their bank and their bank try to sell them into a 401k. And the biggest thing when they do come back and ask us, sometimes they don't. They're just like, hey, here's what I did. But when they do come back and ask, they're like, should I do this? They were talking to me about all these tax credits. And I'm like, let's just hold our horses and evaluate how does it plug into your existing payroll system? Like all of these pieces, it's not as simple as just a cost or just an advisor or any of that, because you don't want to get caught in that compliance situation where it wasn't simple to get the 401k money to the advisor on the biweekly payroll basis. And now you get in trouble. So you have to consider all those parts.
Yeah. So not to scare you, just that this is one area. This is just one of those areas that the audits are high and the risk is there. You might as well find the correct solution for you. And you can outgrow those solutions. You can start smaller, start with a QBO because it's just you're solo, but now you're over 1 million and you have 3 employees in 2 states. And well, QBO isn't doing it anymore. And now I need to swap payroll providers, or I hired a new accountant and they want to use a new payroll provider. And that can be its own project, and one that you, again, are going to want someone to walk alongside you with, because there's timing to take into consideration. There are better times to swap payroll providers than others. That's the end of a quarter, beginning of a next quarter is when you usually want to do that. If you can't, if you're doing it mid-quarter, you've got to account for like the taxes that were already paid in, or were they paid in, or was the company holding them to pay them in at the end of the quarter? Things as a business owner, when you, let's say, are really, really great at architecture that you don't want to think about, and you shouldn't have to. You do need to hire someone, though, who will help get you through these pieces.
Yes, because especially in swaps, there are these, I think it's kind of a little bit ripe for payroll notices to come in the mail. This happened recently for a client. They made a swap last year, and they thought part of their federal unemployment was paid by the prior provider. The new provider thought it was too, because it was part of the reporting that was like, oh, here was his payment. Like, here's what has been accrued. Here's the payment. And then the IRS notice comes in the mail. And so first step there, don't panic. Second step, figure out, like, is it legitimate? Like, where is it coming from? And this is where a good payroll provider, like the good customer support, will help dig in and say, oh, this is the amount that's coming from over here. We thought it was paid. You guys do owe this. Or, whoops, no, there's a filing mistake from our side. We'll amend the filing. There's just a lot of different pieces that have to be analyzed of, like, where is that? Or was the payment made and lost and needs to get applied to the account? All things are possible in that process.
In today's world, it is quite possible. But yeah, it's quite common, right? And that's the weeds. But for sure that some payroll providers will collect the money but not remit it until a certain point. Some will say, hey, do you want us to refund it? And those are all just questions that, as a business owner, I mean, even sometimes I'm like, I don't want to deal with this. For me, it's cobbler's shoes. I'll always deal with it for a client, but for me, I'm like, I don't know. You guys make the magic happen, and
take my money.
Let's sort it all out.
Yeah.
Take my money. I think we just did that because we had to close one of our payroll accounts as we swapped over, and we're like, we are going to be so swamped in January handling all of our clients' filings. We don't care for the IRS notice, so somebody else may take care of that.
Yes,
and that's okay. The other risk that's out there is, let's say you have hired in a state and then subsequently let someone go, or they moved. You still have to file like 0 reports unless you close that account down. And so that is a piece to keep in mind, that you need to file final if you don't plan to reopen in that state, or you have to plan to file 0 reports. But not getting a report is, again, the quickest way for the state to be like, hey, you were here, now you're not here, and we'd like to know what happened. And if there's no money involved, the notices start kind of nicer. Hey, you forgot to make this filing. If you ignore those, what I will see is them be like, fine, we're just going to estimate what you think you owe us, even though it was 0. They're going to put a dollar amount on it because you've ignored them. If there is a dollar amount involved, then they'll do that. But I've seen them get up there on the dollars because the clients just like didn't pay attention to the notices, and I never saw them. And suddenly we're talking thousands of dollars, and we're like, time out. We didn't know anything to begin with. And we'll just pay the late filing penalty, but please make the rest go away. Okay. So you need to just be aware or hire someone who's aware. And that's when you just start making the decisions. Where's your time best spent as a business owner scaling upwards of 5 million, who's going to continue hiring? Is this where you want to spend time in the weeds?
Yep. So if any of those areas felt like a gut check, then that's probably your starting point. You don't have to fix all of the pieces at once, but probably the one that felt the most uncomfortable as you were listening to it is the best place to start. Or if you've gotten any notices in the mail, start there.
Yes. Yeah. And when you send notices, please send every page that you got to your person or to the software. Partial notices don't help, but we have covered a lot of ground today, and payroll goes deep and there's layers. And so, like we said, we really are going to bring on Christina and have time for those expert questions and things. Because if you talk about like getting the reps in or seeing a lot, she has done this for so long that she has seen probably far more than Sean and I have, and probably far more zeros behind some of those payroll mistakes. And so I think she'll bring a lot to the table.
Yes. Okay, that was a lot, but here's the thing about payroll. The mistakes are quiet until they're really, really loud. And by then, you've usually got penalties or back filings, or at the very least, an uncomfortable conversation ahead of you. And the good news is almost everything we talked about today is preventable. You just have to know where to look. So speaking of knowing more, we will have Christina on later this year. We're so excited to do that deep dive. If you want to understand a little bit more about her ahead of that, her information is at valorpayrollsolutions.com, and that will be linked in the show notes. And whether today confirmed that you're just in good shape or it flagged a few things worth looking at, we're always happy to have the conversation with you. Even if we're not the right fit and we can point you in the right direction, that's just how we operate. You can reach us at unfilteredprofit@justprospera.com. So JUSTPROSPERA.com. Or call or text us directly at 531-541-5006. And everything we mentioned is in today's show notes. Thanks for being here, and we'll see you next time.